to contact me offline if you have any questions. And Anthony, we will turn it over to you to take us through the second half of the presentation.
Thank you, Allison, for a wonderful presentation. Okay, before we get into the Schedule J, I guess we'll discuss real quick what the Form 5471 is, and then we'll kind of go through some key terms that we should understand when we're actually preparing the Form 5471. So the Form 5471, it's not just used by foreign corporations. It's also used by U.S. persons who are officers, directors, and shareholders in a foreign entity that's classified as a foreign corporation for U.S. tax purposes. And when you're actually preparing the Form 5471, there are 12 schedules, and obviously we're going to be just talking about the Schedule J today. But more importantly, you probably don't want to start with the Schedule J. Number one, it's probably the most complicated out of all the schedules that you're going to come up against when you're preparing the Form 5471. But you definitely, for example, want to do your Schedule H first, because that's going to be used to report a foreign corporation's earnings and profits, and that's going to carry forward into your Schedule J. All right. So let's talk about some key terms that we need to understand when it comes time to prepare the Form 5471. I mean, the Schedule J, the Form 5471. And one key term is a U.S. person. All right. So only a U.S. person can have a Form 5471 filing obligation, and a Schedule J filing obligation as well. So a U.S. person is generally defined as a citizen, resident of the United States. A domestic partnership or domestic corporation is also a U.S. person. So is a domestic trust or an estate. Now, the definition of a U.S. person may vary a little bit, and we'll kind of get to that in a minute when it comes time for preparing the Form 5471. Another key term, an important term, is U.S. shareholder. Only a U.S. shareholder only a U.S. shareholder of a CFC will have an obligation to file a Schedule J. That may not necessarily be the case for preparing or filing the Form 5471 as a whole, but a U.S. shareholder will have that obligation to file the Schedule J. So who is a U.S. shareholder? That's going to be a U.S. citizen, a resident alien, a corporation, a partnership, a trust, or an estate that owns directly, indirectly, or constructively under Rules 958, 10% or more of the combined voting power of all classes of stock in a foreign corporation, or the value of the outstanding shares of a foreign corporation. All right. Another important term when it comes time for preparing the Schedule J is going to be the term controlled foreign corporation, or CFC. A foreign corporation is a CFC if on any day during the foreign corporation's taxable year, a U.S. shareholder owns more than 50% of the combined voting power or all classes of stock, or 50% or more of the total value of the corporation. Now, when you're preparing the Form 5471 and you're thinking about doing the Schedule J, don't automatically assume that the foreign entity is a foreign corporation. Don't put your client through that if you don't have to. Don't automatically assume if after the foreign corporate or the foreign entity's name, you're going to have a title such as LTD or SA, because you have to look at the U.S. rules to determine whether or not the foreign entity itself should be classified as a corporation, and whether or not it has a reporting requirement under Form 5471 and Schedule J. And you could find those rules in Treasury Regulation 301.77012B8 that provides a complete list of foreign entities that are classified as foreign corporations. And then there's some other rules as well, which get a little bit more technical and beyond the scope of what we're talking about today. But anyway, definitely check out the regs before going ahead and assuming a foreign entity itself is a foreign corporation. Then finally, the last term, which is important, is 965 specific foreign corporation, or SFC. An SFC is a foreign corporation that is either a CFC or has at least one shareholder that is a corporation. So that's going to be the definition of SFC. All right. We've heard an excellent discussion earlier about the categories of filers, but I'm going to go through it real quick because this is so important for purposes of the Schedule J, because if you basically have to be a certain category of filer in order to have a filing requirement for Schedule J. All right. So there are basically 5 categories of filers, and then there's going to be 3 additional categories of filers for Category 1 and Category 5. So your Category 1 filer is a U.S. shareholder of a SFC at any time during a taxable year of the SFC who owned stock in that corporation on the last day which it was an SFC. All right. Now, Category 1 has been expanded as well recently to also include Category 1A, 1B, and 1C. Real quickly, a Category 1A is basically going to be your catch-all category. And then your 1B category filer is going to be a U.S. shareholder that owns stock in a foreign corporation directly or indirectly, but the shareholder is unrelated to the foreign corporation within the meaning of Section 954(d)(3). And then your Category 1C filer is going to be a U.S. shareholder of a foreign corporation, but only because of the constructive stock ownership rules, which can be found in 318(a)(3). All right, so Category 2. Category 2 is basically a U.S. person who is an officer or a director of a foreign corporation, which there has been a substantial change in U.S. ownership. Even if that substantial change of U.S. ownership does not relate to that officer or director, then you're going to wind up having a Category 2 filing requirement. What is a substantial change in U.S. ownership? That is basically when a U.S. person acquires a block, a 10% block, or acquires an additional 10% block of ownership of the foreign corporation by vote or value. So therefore, if there's a substantial change in the ownership of a foreign corporation by a U.S. person, and you have a U.S. U.S. person who's classified as an officer or director, then you have a Category 2 filing requirement. There are some complicated attribution rules, which is beyond what we're talking about here today, beyond the scope of this course. But anyway, it's on the slide that we've included, and it's kind of interesting how you can wind up having a Category 2 filing requirement, even if you don't have direct ownership of the foreign corporation at issue. All right, Category 3. Category 3 is a U.S. person if any of the following has been done during the year. So if the U.S. person acquires stock within the foreign corporation within the meaning of Category 2, which is the 10% ownership requirement, or they wind up acquiring an additional 10% ownership requirement. So basically, if there's an additional ownership of 10% or more, which is done through an ownership or reorganization, then you're going to wind up having a Category 3 filing requirement. All right, now we're going to move on to Category 4. And Category 4 is, as Allison mentioned earlier, the category which kind of triggers the filing requirements for many of the schedules in a Form 5471, including the Schedule J. So what is a Category 4 filer? A Category 4 filer is a U.S. person who basically acquires at any time during the year or should I say, possesses at any time during a year more than 50% of the total combined voting power of all classes of stock entitled to vote, or more than 50% of the total value of the shares of the foreign corporation. And it's only at any given time of the year. It doesn't have to be through the entire year. It doesn't have to be at the end of the year. If at any point during the year, if you have a U.S. person that owns 50% or more of the voting power or the value of the foreign corporation, then you have a Category 4 filing requirement. There are some really interesting attribution rules that apply to this. But we could spend a couple hours just talking about it. Unfortunately, we don't have time to discuss that now, but I did include that into the slides. So you have to always, when you're looking at whether or not somebody is a Category 4 filer, look at your attribution rules as well. That could, or your constructive ownership rules, that could easily trigger a Category 4 filing requirement for purposes of the Form 5471. Okay, and the final category is Category 5, and Category 5 is an individual U.S. person who basically at any time during the year owns stock in the corporation, or on the last day of the year owns stock in the foreign corporation, which is more than 50%. And so, and also Category 5 has been expanded to include Categories 5A, 5B, and 5C. And basically, as with Category 1A, Category 5A is going to be a catch-all category. 5B, like 1B, is basically when you own shares of the foreign corporation through a corporation, through corporate ownership, or indirect foreign corporate ownership. And then 5C is similar to 1C in that you become a Category 5C filer because of the constructive ownership rules and the downward attribution rules. All right. Now, since we got that out of the way, let's move on to the actual Schedule J. All right. So when you're starting off with the Schedule J, you're going to look over at the form itself, and the form itself is going to basically ask you what category of income that you're going to have to go ahead and state onto the form itself. So you're gonna there's going to be you actually have to go ahead and look at IRS Form 1118, which will provide you with the 6 categories of filers for purposes of stating the category of income on the top of the form itself that should be stated. And basically, the categories of income would be 951A, foreign branch income, and by the way, 951A is going to be your GILTI, your passive or PAS if it's passive income category, 901J, which is basically income itself that is through a so-called blacklisted country, and then you're going to have your RBT income, which is basically income resource by treaty, and then you're going to have your GEN, which is going to be your general income category. So you start off with that, all right? And that's going to be line A. Line B basically states that if you're dealing with a country that has been sanctioned, you're going to have to basically go ahead and enter the 2-letter code, stating the country code that should be entered if the CFC itself is in a country that has been sanctioned. Okay. Then let's move on now to before I actually get into the actual ordering rules of so forth. You're going to have a box right on top of Part 1, and the box basically asks if you don't have all the information regarding the U.S. shareholders, then you should check the box. I often say to people, be very careful about checking that box. That invites an IRS audit if that box is checked. All right. Let's now talk about the categorization and the ordering rules. remember when I was back in law school and I took my first class in federal income tax. I remember my professor the very first day of class saying, um, going over start going over the basic rules of basis, and the professor said, "Look, if you don't get these basis rules, you're never going to understand the concept of federal income taxation." And when we talk about the 959 rules, it's kind of similar to that. You got to understand the 959 rules, ordering rules, and the rules regarding PTIPs and so forth that fall underneath the 959 rules in order to properly prepare the Schedule J. So anyway, let's start off with the basics. All right. So if you look at it, where this whole thing start off with? It started off with, or why do we even have to say? Why do we even have categorizations of income? Well, you have categorizations of income. It started because of foreign tax credits. Under Code Section 904B, for purposes of calculating foreign tax credits, there was a requirement that, or still is a requirement that, income itself is allocated to certain categories or boxes or baskets. And basically, right now today, when you're dealing with accounting for any kind of outbound transactions, you're going to have to go ahead and categorize the income to certain baskets. So these baskets are baskets for passive income, a basket for GILTI, a basket for foreign branch income, and there's a general catch-all basket for active business income. So you start off first when you have offshore income. You have to go ahead and allocate the income itself to a certain category under the 904 rules. All right. Then the next step is if you have previously taxed earnings and profits, then you have to go ahead and apply the 959 rules. As Allison was mentioning earlier, prior to the Tax Cuts and Jobs Act enactment in the end of 2017, basically categorizing previously taxed earnings and profits, or PTIP, was relatively simple. It was broken down into three categories. And under 959C1, you had a PTIP allocated to any kind of investments in U.S. property. All right. Then under 959C2, you had PTIPs, which was allocated to Subpart F income. And then under 959C3, you had PTIPs, or income itself, that was basically put into a general current or accumulated E&P type of situation, or basically that was when the earnings and profits were not taxed yet. So it was relatively simple. Then the Tax Cuts and Jobs Act were enacted. You had Code Section 965 that was enacted. You had a bunch of other items of foreign source income that kind of found its way into the Internal Revenue Code. So that made these rules, I wouldn't say obsolete, but you had to add to them. All right. So in November 28th of 2018, the IRS goes ahead and they issue guidance. And they basically issue a guidance in the form of proposed regulations. And they basically expanded the number of PTIPs from our simple 3 all the way to 10. All right. Then in 2019, the IRS issued a notice announcing their intentions to issue regulations on PTIPs, which hasn't happened yet, but they also went ahead and expanded the PTIP groups from 10 to 16. All right. Then the final regulations under Code Section 960B were enacted on December 17th of 2019. And the good news about it is that the regulations itself basically reduced the number of PTIP groups. And the regulations itself, although the IRS has not finalized regulations under 959, these regulations itself kind of fit in really well with the current Schedule J. All right. So as I mentioned, the PTIP groups itself has been reduced somewhat. So now, rather than having just one group in your 959C2 group, that the PTIP groups have now been expanded to 5, and we'll see how that plays itself out on the return in a minute. But it's been expanded to 5. So now, what are the categories that fall under 959C2? So you're now going to have 965A, which is basically going to be classified as a PTIP group under 959C2. You're going to also have a 965B4A. That's now one of those that is one of that 5 which group which I mentioned. You're also going to have a PTIP group for 951AF2, which is basically going to be allocations of guilty to the CFC. And then you're going to have a group for 245AD, and that's basically going to be prohibiting a taxpayer from claiming credits and deductions for foreign income taxes paid or accrued on dividends within Section 245A. And then you're going to have a group for 954A1A, which is Subpart F income. You're going to have the same changes as well for 959C1. You're going to have the exact same changes which gets carried over from 959C2. However, there is a couple changes as well. You're going to have a group also for hovering deficits under 959C3. And then you're going to also have a PTIP as well assigned to, or an allocation assigned to 909 anti-splitter rules, which we'll discuss as well in a minute. Okay, all right, so now let's start going through the actual columns of the Schedule J. And let's start off first with Part 1 of Schedule J. And so Part 1, it talks about your CFC basically having to report the EMP in functional currency. So, well, sometimes I get the question, what is functional currency? Functional currency is typically the US dollar. However, if the currency or the economic environment where the foreign corporation is operating is another currency, or if the conduct of the transactions itself are kept in books and records that reference or that are kept in the foreign currency, then you're basically going to be reporting your numbers here for the PTIPs under the functional currency, which very well could be foreign currency. All right. So column A, column B, and column C, this is going to be all 959C3. Why is that important? Because 959C3, it's basically income that has not been taxed. All right. So when you're approaching when you're first looking at the Schedule J, and you look at those first 3 columns itself, keep in mind that those first 3 columns itself, you're going to be dealing with income itself that has not been taxed. All right. So for column A will basically discuss any kind of post-2017 EMP that has not been taxed. And you're going to go ahead and report under column A only EMP that has been accrued since 2017 that has not been taxed. And you're going to go ahead and report it under column A. Column B, you're going to basically report all your EMP that has not been taxed since, should I say, before 2018. Now, if you're going ahead and you're reporting underneath this column over here, keep in mind that you've had your 965 rules come into play already. So there's not going to be many situations where you're going to have EMP that's not been taxed prior to 2018. So if you start filling out column B, just stop yourself and think, am I doing this correctly? All right. I don't have time to go through it, but for purpose of the slides, I left an example on how the pre-2018 income itself was calculated. All right. Column C is basically going to be for pre-1987 E&P that has not been taxed. So basically, if you have E&P on the books that has not been taxed prior to 1987, then you're going to wind up basically entering that under column C. Once again, if you're filling this column out, ask yourself, am I doing this right? If you're entering numbers in under column C. All right. So column D discusses hovering deficits. And basically, if you have hovering deficits, you're going to wind up entering under column D. You may ask yourself, what is a hovering deficit? A hovering deficit will typically involve a situation where you have two foreign corporations that might be merging or having a transaction. And then basically you have a situation where you have an E&P that's in the form of as a result of a foreign tax credit or some other transaction where you have E&P that has not been taxed. You're going to be winding up filling out column D and then putting it under column D. All right. I went ahead for purposes of slides. I've included an example of how this is calculated. I took that right from the regulations. So if someone has questions regarding the hovering deficits and how it works, hopefully that will be helpful. Okay, now let's move on to column E1. All right, so column E1, and before we move forward with the next few columns, I think it's all up to column 6. Yeah, from column 1 through 5. This is going to be your E&P that is related to U.S. property. All right. Now, for whatever reason, the IRS decided to have a bunch of categories here for 956 type of income, which is basically in any kind of investments into U.S. property from a foreign corporation. Really, under today's rules, it doesn't happen too often anymore. As Allison alluded to earlier, where you're going to wind up seeing this mostly is where you have a foreign corporation making a loan to a shareholder or a related person to that shareholder. That's where you're going to wind up having a situation of having U.S. income, or should I say U.S. investments or U.S. property that should be reported on the Schedule J. All right, so column A1, you're basically going to wind up reporting any type of investments in or PTIPs associated with U.S. property. Column E2, that's basically going to be, your column E1 is going to be if you have 965 inclusion that has been reclassified as investments in U.S. property. Column E2 is where you're going to have 965B PTIP that has been reclassified as an investment in U.S. property. And then column E3 is where you're going to wind up having basically just investments in U.S. property, kind of reclassification. And then column E4, you're going to wind up having a PTIP if you originally had an inclusion under the GILTI rules, and then you had a reclassification where it was reclassified for purposes of making it a PTIP that is associated with an investment in U.S. property. All right. Let's talk about column E5. So column E5 is basically when you're dealing with a U.S. company that has taken a hybrid dividend from a foreign corporation. Now, if you look at the instructions for column, and by the way, this is anything that you're reporting under column E5, once again, is going to be a PTIP that's reclassified as U.S. property, all right? So if you have a situation of a hybrid dividend, Or if you have a situation where you're dealing with a 1248 amount, a 1248 amount is, let's just say you had a sale of a stock of a CFC, and the stock itself had retained earnings within the basis of the share. When you sell the share, it's not taxed as capital gains rates. The 1248 would basically tax that as ordinary income. So if you have a PTIP related to that, that's been reclassified to U.S. property, that's going to fall under column E5. All right. For most of us, when we're dealing with preparing the Schedule J, we're going to be kind of living in the world of the E6 moving forward to the E10, because these are just basically going to be your PTIPs that are not associated with U.S. property. And like I said, the way the tax law has changed since the Tax Cuts and Jobs Act, the amount of PTIPs that you're going to have that's related to U.S. property, it's going to be minimal. All right. So for column E6, so you're going to wind up reporting. And by the way, let me just back up a second there. So anything that you're reporting from E6, column E6 to E10, this is going to be reported under section 959C2, whereas earlier we were talking about 959C1, which is the investment U.S. property. So now we're dealing only with PTIPs that are classified under, or which is previously taxed income, that's classified under 959C2. Once again, not related to U.S. property. All right. So your first column here, your first column that you're going to be dealing with, which under 959C2, will be dealing with the transition tax. So if you have PTIP from a 965A type of situation, you're going to wind up basically reporting that under column E6. Under column E7, if you have a PTIP related to 965B4A, you're going to wind up reporting it there under column E7. So what is it? That's a situation where, say, prior to 2018, you had multiple CFCs, and for purposes of 965, you offset one CFC's EMP from another. You're going to be winding up reporting that PTIP under column E7. Okay, so now under column E8, you're going to wind up reporting any kind of PTIPs attributable to 951A, which is going to be your GILTI. Under column E9, you're going to wind up reporting your PTIPs that's attributed to the 245AD under section 959C2. And once again, this is dealing with a situation mostly where you have a domestic corporation that receives a hybrid dividend from a foreign corporation. And that's how, in most cases, if you have a PTIP related to that, you're going to wind up reporting that under your E9 column. Okay, so column E10, basically that's going to wind up, you're going to wind up reporting your PTIPs that's related to Subpart F income. If you have Subpart F income, you're going to wind up reporting it under column E10. Column F is basically used as an opening and closing balance of the foreign corporation's accumulated ENP. All right, so now since we've walked through the columns, let's go through the lines. All right, so line A1, basically it just asks you, the preparer, to go ahead and enter the balances of each column, for purposes of line 1A. Okay, so line 1B, basically, if there's a difference in the balance between the present year and last year, you're going to wind up reporting that under column 1B. Now, line 2A, we kind of talked about this a little earlier. We talked about the anti-splitter rules. So what is an anti-splitter rule? Real quick, for purpose of taking a foreign tax credit, a company or an individual can take a foreign tax credit. Under foreign law, they're liable for the tax in the foreign country. The problem is you have a lot of situations where you could have a U.S. reporting corporation or another foreign corporation wind up reporting the income, which would be kind of separate and distinct from the entity itself that is legally liable for the foreign tax. And it winds up happening an awful lot when you're dealing with transfer pricing adjustments, or if there's shifting of deductions between related entities. So if you have a situation like that, you might get a suspended tax, and then basically have to refer to Code Section 909, which kind of defines this tax splitting event and how to treat it for purposes of the Internal Revenue Code. But anyway, if you have a situation which is involving the anti-splitter rules, you're going to wind up reporting that under column 2A, and as well under line 2A and line 2B, if you're dealing with a situation where you have an anti-splitter type of situation. All right. So line 3, remember in the beginning I said that you don't want to be doing your Schedule A first. You kind of want to wait to do your other schedules before doing your Schedule J. And I said to you, you definitely want to be doing your Schedule A first. And here's the example. For line 3, you're going to have to basically take the amount or a deficit or the EMP from line 5C of Schedule H, and then you go ahead and you'd enter onto line 3 of your Schedule J. All right. Okay, so line 4, you're going to wind up reporting any positive numbers from the previous tax income from a lower tier foreign corporation. You'd basically wind up reporting that on line 4. Line 5 asks if there is any earnings that are carried over from a surviving corporation after an acquisition of a foreign corporation of its assets, described in Code Section 381. So if you're dealing with an M&A type of a cross-border M&A type of transaction, you're going to want to wind up looking at your rules very carefully for determining how to go and report it on line 5A. And then the same thing goes for line 5B, which talks about, so line 5A talks about the income line. Line 5B talks about any kind of deficits that are recharacterized as hovering deficits. Okay. Line 6 asks if there's any adjustments to the EMP that needs to be taken into consideration. If there is, then an attachment should be made to the Schedule J. I left for purposes of the slides an example on how this would come into play. This is taken from the IRS instructions. All right, line 7, basically it talks about if there's any kind of actual distributions or inclusions under Code Section 951A1 or 951A, which is going to be your subpart F, and you're guilty. So if there's any kind of distributions and inclusions, you have to report that under line 7. Line 8 asks if there is any kind of includable income as well that should also be reported on line 8. So line 10, basically if there's any kind of reclassifications from Code Section 959C2 to 969C1, if there's that reclassification itself, you'd report it on line 10. See if there's anything else here. Okay, real quick, for part 2 of the Schedule J kind of discusses if you're dealing with subpart F income, if you have any previously taxed EMP subject to recapture, of the subpart F income in functional currency, you're going to need to report that under Part 2. So if you have a situation where you're dealing with subpart F income and there's a recapture type of situation, then make sure that that's reported properly under Part 2 of the Schedule J. Okay, so that's about it. I'm done with my presentation. If anybody has any questions, please feel free to reach out to me. You can email me or just give me a call, and I'd be more than happy to answer any type of questions that you may have in regards to the Schedule J.